What I'd like to do is to hear you, if you could give the simplest Vanguard-like, index fund-like financial game plan for somebody who's over 50. Now, of course, each of us has all these individual factors, what decisions we've made, but the average person over 50, how simple? What is the simplest 10-minute solution or half-hour solution to getting Vanguard returns?
Well, I'll give you a simple solution, but the one thing we know about the average is, unlike Wobegon, there are a whole lot of people that are here and here and here, and the average is here. So in essence, nobody's average. You're all a little bit above average or a little bit less than average. You may have greater risk tolerance. You may have greater income requirements. You may have greater financial ambitions and are willing to take risks to accomplish them. But in all those cases, the lower the price you pay for owning the stock market and the bond market, the better off you are. Now, I have talked about a rule of thumb, and I want to underscore it's a rule of thumb, a place to begin thinking about having your bond position equal your age. So when you're 20, you'd be 80% bonds. Now that's a rule I would not dream of, 80% stocks. And I wouldn't dream of telling somebody to with their first investment to be 80% in stocks. They should be 100% in stock. You know, in the first year, maybe they'll put away $1,000. That's a drop in the bucket to compare to the value of their career and the value of what the investments will ultimately be. And by the same token, at least at these interest rate levels, I'll comment on that in a second, I wouldn't dream of telling everybody who was 87 why
you say that with pride. You say that with pride and enthusiasm.
To be 87% in bonds. I am not. I'm approximately 50-50. And so a lot depends on your own requirements. And this rule of thumb, first of all, very important for people to think about, and that is just about everybody that you're going to be talking about, every investor you're talking about, also has Social Security. And that has a capitalized value. What is that? The size of that asset pool you would need to create the returns you get in your monthly Social Security check? Probably $350,000. So if you have $700,000 and $350,000 in Social Security, and you put 100% of your stocks into that, so it's $350 in stocks, $350 in this bond-like investment, and you're 50-50. So take that into account. If you have a pension from a local government or from a corporation that's not going to go bankrupt, I quickly add, you should add that in. What you're trying to do when you retire, which I am going to do someday.
I think you're going to fail at that. I think you're going to fail at that,
Would
Jack.
not be my first failure. But when you want to do that, you want to ensure a monthly flow of income. So don't watch the market. Just make sure your portfolio is producing income and will continue to produce income. So you get your Social Security check every month. You set up your mutual fund account or your index fund account for a monthly payment. You can do that. And just you want those payments to be stable, and with respect to Social Security and the fund alike, will grow a little bit over time. Dividends are an extremely important part of this. And you know, ever since the 30s, which were a terrible time, early 30s and the Great Depression, when dividends probably got cut 75%, there's only been one period of time.
Not that long ago. Well, we're almost 7 years
where dividends
out.
were cut by, I think, about 25%. And that was from 2008 to 2009, when in the financial crisis, the banks had to eliminate their dividends. But it's a line like this with this one bump in it. So I think you can count on that under any foreseeable circumstances, to which I quickly add, there are a lot of unforeseeable circumstances out there.